Let's talk about usage of digital tools as profitability drivers. We may highlight five main areas of profitability growth. First, it's growth of sales. When we plan several digital activities, for example, we want to increase conversion rate at our digital services. We need to rebuild several other pages. We need to implement contextual help or bot, or we need to launch some new products. We need to calculate incremental effect, some extra effect, some uplift to our sales. For example, before our sales of loans was $1 billion of dollars. With this new feature, we will get 20% of incremental effect of sales, and we may use this incremental effect. Also, we may use a term of saving or retention of our sales. For example, if we talk about two car brands, just imagine if one car brand produce new models of cars and new features of cars 5 years, and several brands don't provide to market new cars, new features, and what we think is sales of car brand without new features will be equal as 5 years before. No, and it's important to share this understanding to finance department who analyze some new activities, and also it's important to share it to management board who give us the money for implementation of new services. And also you may think about some period of obsolescence. In business case, it usually 3 years from implementation of some activities. And next, you need to calculate how much you spent, for example, 1 million for launching of new products, and how much you will get. And you need to compare it. Next, it's growth of cross-sell. Also, it's your incremental effect to new cross-sell of some additional product to your main product. For example, insurance to personal loans. Next great area is decrease of operational cost. It's really linked not only to digitalization, but to topic of economy of scale. It's great and very deep topic. I recommend you to look to it because at your business, you need to go to your financial model. You need to analyze your some cost and profit details. But at any business, you may have some fixed cost. For example, you already have your branch network and you need to pay for it. And also you have your semi-fixed or some increment cost or some flexible cost. You may use a lot of terms, but it's real cost of sell of one your product or real cost of one of your operation, and in terms of economy of scale, for example, if currently you sell 1 billion per year and you will double it to 2 billion per year, your flexible cost will be different, but your fixed cost may be the same, and it means your total cost will be lower. Next, you need to think about two approaches. For example, when we try to present our digital products, and when we show our cost decreasing models, our financial department asks us if we need to save money, how many people we will fire, because they need to see decrease at absolute values of our costs. But you also may look to relative values. For example, if you increase productivity of your people, if you increase level of business, level of sales, you may provide more business with the same amount of your people. And I think from ethical point of view, it will be more better approach, and from business point of view, it also you will save your expertise at your company. Next, it's risk decrease. At different banks, you may use different terms, cost of risk, SRC level. You may have some buffer of risk. It's also linked to requirements of regulator at each country, but also you may use absolute and relative values of risk, and with digital tools you may decrease they both. And last area, it's Net Promoter Score, NPS, or Client Satisfaction Index, or loyalty. And it's really a tricky question, because it's not easy to calculate how loyalty of clients have an impact to your business and your profit. And you may analyze it through potential clients outflow, through increase of your sales level, through increase of your cross-sell level, through decrease of level of cost of service and claims management. We will talk about it next part of our course. And just as one more reminder about each approach of calculation at each area. At sales, you may use not only new sales, but also use term of retention of current level of sales. And also you need to consider probability of success, because if you need to decrease your level of OPEX, it more manageable area, because you know that you spent $100 for some operation. If you decrease 20% of it, you will save $20. But if you launch your new product, you need to set some rate of probability of success, because after 1 year your finance department will ask you about results. And at our scoring models, I will tell about it at the next part, we use for sales activities also probability of success. If we talk about cross-sell, it's important from pricing point of view to find equilibrium point of profit growth, because if you will use really high pressure to client and ask about buying of several additional options, you may get refusal at sale of your main product. Next, at the point of decrease in operational cost, really this use Lean Six Sigma approach and look not only direct cost of that operation, but also error and refusal level. Also, it's interesting point when you improve efficiency of your operations, you increase level of increase quality of time to yes speed, and it has an impact to your sales. It allow you to sell more. If you go to risk, you also may predict a lot of your activities, for example, microsegmentation. You may use also not only impact to risk decrease, but also impact to sales. Because if you will provide more better quality of your, for example, approval rate, your brand will be higher, your clients will recommend you, and if we go to loyalty, yeah, you may analyze potential outflow. It means losing of profit and new sales. You may use impact to cross sale, because if your client not loyal to you, it means they will not buy several more products. You also will calculate level of recommendation and sales through recommendation. You may look to corporate and retail interrelation. For example, if you provide bad quality of service to individuals, some corporate clients may also left your bank. You may analyze products and segment interrelations, and also loyalty and risk interrelations.